Hi everyone.
Hi there.
Right, good to see everyone's here. So just as a quick introduction to today, really this roundtable, following on from our last event, is really around innovations in working capital. And I'm really glad to see the panel that we've got on board for this event, because it's some really interesting people doing some really interesting things in the space. I'll let everyone introduce themselves in turn independently, and then we will break out into questions around the space, a bit of open discussion where everyone's free to join in. And again, people watching, feel free to add in questions. As always with these events, we will get round to them, and we'll add them into the conversation where we can, as well as talking points. So not to waste any time, if I could have Piotr, you introduce yourself and Uncapped as a starting point.
Hi, sure. I'm Piotr. I'm CEO and co-founder of Uncapped. We are the leading revenue-based lender in Europe. We focus on providing short-term working capital solutions to startups in e-commerce and software as a service space, both in Europe and US.
Great, thanks very much. And Henrik, could I have you introduce yourself and CapChase?
Sure. CapChase, I'm Henrik. I'm the general manager of Europe for CapChase. We're a fast-growing provider of revenue-based finance for recurring revenue businesses exclusively. We offer programmatic funding model, essentially allowing our customers to tap into cash flow on demand, optimizing the financing for their business needs, even on a weekly or a monthly basis, which essentially leads to reduced cost of capital and improved ROI of that spending. Originally from the US, but entered Europe just a few months ago, and seeing a lot of interesting market sort of pull for our type of financing options. So very excited to be here.
Great, very interesting. And Steve, just yourself and market finance, please.
Sure. Hi everyone. Yeah, I'm Steve Lomax. I'm the COO over here at Market Finance, and our purpose is to provide small businesses with the right business finance to solve the cash flow issues that kind of get in the way of progress. So we've got a range of financial solutions, and to date we've lent around 2.6 billion to UK SMEs in a host of sectors: media, hospitality, logistics, e-commerce and professional services, just to name a few. And looking forward to the conversation this afternoon.
Great. So if we get going on the questions, and the first one really that I think is interesting to talk about is why working capital is becoming so important now. Really, as sort of larger financial institutions, incumbents have pulled back in, I say recent years, but over quite a long period now, why it is so important that, you know, alternative players who are now actually not so alternative anymore are really sort of stepping into this space and actually making people realize why these facilities are so important, why working capital is so important to manage and have available at any time, and really how the newer players in the market, such as yourselves, I say new versus incumbents, how they're actually going about making that possible for SMEs, how they're making these working capital facilities available to them, and again, how that's growing and showing importance of those facilities. If I could start with you, Steve, as you're probably one of the longer running players in the market, it'd be good to start with you and get your thoughts on how that's evolved and why it's so important now.
Yeah, absolutely, Sheriff. And I think you've kind of touched on, I guess, the point I'd start with, which is, you know, it's an environment where it's not necessarily getting easier for small businesses to receive it from maybe some of the traditional providers. But, you know, my belief is, I think there's always been that inherent issue for small businesses where there's that need to meet regular weekly or monthly payments, such as payroll, that often occur in advance of receiving payments back from customers or, you know, contracts they've got. And I think in the early days of the pandemic, you know, the need for it was really to bridge gaps where, you know, the customer demand might not have been so high, et cetera, et cetera. But what I'm seeing now, I think, and, you know, the bigger trend is as we're coming through the pandemic, we're seeing a whole host of sectors really going back to focusing on growth again. And they're looking to build capability, whether that's people, whether it's stock, whether it's machinery, whether it's technology, to give them the fuel and the ability to grow further. But again, those items often need to be funded ahead of receiving payments back. So in my view, I think one of the big triggers at the moment and looking forward is that move back towards growth, where I think the working capital needs to become even more important than they have been in the past.
Yeah, really interesting. And again, Piotr, from your point of view, again, you're one of the slightly newer players in the market, and again, have probably come in at a different economic period and a different sort of place for businesses than when, for example, Market Invoice, now Market Finance, was first created. So it'd be really interesting to get your views on, especially with you guys working with some of the smaller SMEs up to the larger SMEs, what you're seeing in terms of those trends and the importance of working capital.
Sure. I mean, let me start, the history of Uncapped was, I used to be a VC, and as a VC, I met thousands of these companies who were trying to grow, were looking for the capital, but they were not served by the existing players because, they didn't have history, they didn't have assets, they were subscale, so they couldn't get the bank lending or any other lending. On the other hand, either they couldn't get the equity or they were getting equity at a very expensive price, and like to give up 20-30% of your company just to give this money to Google and Facebook, it doesn't seem like a good deal. So the Uncapped was created to help these companies with decent economics. They knew, they had repeatable growth to be able to take this growth and scale the business further. Now, we started almost 2 years ago, and maybe 3-4 months after we started, the COVID happened, and this was a very interesting period of the company because suddenly the market froze, and all these companies couldn't get any form of capital. Suddenly, and everyone stopped lending. The VC investments dried out, but we accessed the real data, and we've seen that there were many businesses which continued to grow and they continue to persevere. And like with the real-time data, hey, this business is doing well. Why is no one else giving them the capital? And we were, because of this real-time element of underwriting, we were able to offer this capital to them. Today, we're growing almost 1,000% year on year, and we're lending tens of millions a month. And we're very happy with how many businesses we help to scale. And we already have a first unicorn who got funding from us when they were just worth £10 million. So we're able to save tens of millions of equity to these founders who were not able to, who otherwise would have to give away this capital to the investors.
Yeah, really interesting. And Henrik, coming to you finally, it would be really interesting to see actually what you're seeing, having recently moved from the US into sort of the UK and further across Europe as well eventually. It will be really interesting to see, again, that same question, why working capital is becoming so important in the current environment, but again, how you're seeing that in contrast between the US and Europe.
Sure. I think on the first question, right, in terms of, I fully agree with Steve in the sense that, in a growth mode, cash is always, you're typically always cash strapped, right? So there's always this need for capital. I think the almost the more interesting trend that we're seeing right now is the increased flexibility that we're getting from some of these digital lenders and the broadening of what people used to consider working capital financing, right? I think if you look back, financing used to either be large, long-term and cheap, but very slow and only available to some, or it was small, very short-term and expensive. And that's sort of what you get when you have poor data models, right? And manual processing of that data. However, to Piotr's point, we're now accessing real-time data, and those lines are now really blurring. So we can we can be much more tailored in our understanding of risk and adapting the offerings to the needs of the business. So we can actually move from having been large, long-term and cheap, or small, short-term and expensive, and be large, short-term and cheap, right? And there's something very interesting in how you can actually start thinking about using working capital financing in different ways. And I think if you look at Europe versus US, there's a really interesting dynamic there, because in the US, you see founders and entrepreneurs use non-dilutive financing, debt financing, to a much greater extent than we see in Europe. And I think it's, we're obviously mainly sort of spending our days in the technology industry. But even there, you see that founders are much more well-versed. They're much more well-understanding in terms of the different options of non-dilutive financing that's out there. And that's one thing that we're starting to see now, that the ecosystem has matured and realized that actually, to Piotr's point, I don't always need to use venture capital. I can use other forms of financing. And there's a plethora of different sort of providers out there. I just need to understand what provider and what type of product suits my capital needs at this current point. And I think that's where the interesting bit is, that now being data-driven and going so many levels deeper in terms of understanding the companies that we provide financing to, we can actually serve them in a much more tailored way. So I think that's, to me, the most interesting sort of trend in working capital financing, that we're now much more precise in what we can offer.
Really interesting. And I think that leads on quite well to the next question I had, which is, we've already touched upon it, but it'd be quite good to go a bit deeper into it. And that is, there has been sort of historically, especially since the last financial crash, a sort of stigma that arose around having credit for a business. It used to be very much the mindset of, we've done very well in business and it's allowed us to have fantastic credit lines and fantastic credit available, which has again allowed us to progress the business even further. It was always sort of a reward for doing good business, as it were. Since the crash, it's become almost a stigma was created around, well, if we need credit to run the business, then we're in trouble. Or if we're accepting a lot of credit or debt facilities, it probably shows we're not doing good business. And people sort of, their mindset's almost completely did a 360 turn or 180 turn and reversed on itself. And I think one of the things that alternative lending or sort of the newer lenders have done is help bring that back into perspective, that actually credit isn't a bad thing. Debt facilities, things like that, are not a bad thing. They are there for growth, and that's how they were always initially seen. So it'll be really interesting to get perspectives on what specifically, whether it's parts of the journey, whether it's the customer experience, what are newer lenders bringing to the table that's really helped that and bring a sense of sort of trust and almost a sense of reward back into having these sort of facilities available for business. If I go to Piotr for that in the first instance, again, coming into the market fairly more recently, I think you've come into quite a nice time where that thinking has kind of evolved and is still evolving, but you've come right in the middle of it and obviously done very well by doing exactly that, bringing something to the table that's actually made businesses trust in business credit.
Yeah, I think, from our perspective, we always believed that trust of the customers is, the biggest asset we have. And, this is the key differentiator we can have versus everyone else. And from day one, we designed the company around gaining trust of our customers. And it shows everywhere. It shows with the way we communicate with the customers, with the way we have access to us. But in the simple things like, when we started to work on our debt agreement, we pushed ourselves, can we make it as simple as possible? It took us 3 months of working with the lawyers and rewriting everything again and again to make the agreement understandable by the client and short. Like our loan agreement is only 6 pages long. And it's written in a language which every founder can understand, because we want them to make sure, they know what they're getting. They know the rules, and the rules are simple and straightforward. We never charge. There's no hidden fees we charge. And no, this is a very big principle of ours. There is no hidden fees, and we want to make sure that people are never caught off guard by any penalties or anything happening. Of course, if you misbehave, we'll go after you. But as long as you're working with us, we are very friendly. And it's even our motto is a friend that take on the capital, because we want to make sure that the founders don't see us as another lender, but as a partner in growing their business. How we think about it, is like 50 years ago, the banks were local, and the banker was your friend who understood you, give you the credit, and was helping you to scale the business. And this is where we are going today. We are moving to become a neobank. So we already launched our neobanking proposition in the US, and we're launching this in Europe now. And what we want to do, or what we're becoming, is this lending-focused neobank, which will be helping companies from the moment they started to their IPO.
Great, that's really interesting. And Steve, can I come to you on that point as well?
Yeah, absolutely. And I expect you're probably going to hear some common themes through this as well, Sharif. But just picking up on Peter's point, I think trust is really, really key. And that whole customer relationship and customer experience. So that concept of, I think, as Peter was saying, that, you know, a while ago, you go to your bank manager and you'd know them and they'd be very, very local. So, you know, what we're trying to do is keep that relationship level there, but use modern day technology to complement, you know, the personal relationship as well. And ultimately, I think in terms of reversing that stigma around credit, a lot of it's around the process. So we're trying to make this process as simple and as hassle-free for companies as possible. We don't want that process to feel like someone's got to go cap in hand, and it's a really, really Herculean effort to go through that process. So how can we use data, insight, technology to simplify that as possible? And again, clearly we'll perform the right checks, etc. But it's keeping it as simple as possible is one element of, I think, addressing that stigma. The other area I would say is, and we've touched on it earlier, we've kind of created a blog and a series of case studies around what we're calling the Growing Business Club. And it comes back to that earlier point, you know, and I think Henrik highlighted it well. You know, to fuel growth, you need working capital. So we want to try and get the focus on fueling growth rather than having to apply for credit, to try and reverse that stigma as well. So, you know, this is a topic we could probably spend hours and hours and hours on, but those were the two that I'd probably highlight, making it a really easy process, and then, you know, conceptually making it more about growth rather than actually going cap in hand for credit.
Yeah, great. And Henrik, again, I'm sure Steve's right here and we're going to echo a lot. But again, I think it's really useful having you here just to get that with you guys starting in the US. Do you see the same sentiments moving from the US into Europe? I know you said the US is actually typically more inclined to use the sort of non-dilutive facilities and things like that. But is that something, again, you're seeing progress in the US in terms of, with your own evolution, that's actually building more and more trust and momentum in that side of things? Or is there a difference between the UK and the US when it comes to that?
Yeah, there's definitely a difference. And I think, you know, if you think back to what's been going on in consumer fintech the last sort of 10 years, right? I think there's been a big sort of market education going on. And I think that's exactly what we're seeing right now in the B2B space around lending. To both Steve's and Piotr's point, right? A lot of what new players are doing is being transparent, being easy to work with, and keeping a very sort of simple and understandable customer experience. And I think it's essentially what's been going on in consumer fintech the last 10 years. And I think we're starting to see similar, you know, happenings in the B2B space where, you know, by just being open and clear and move quickly, we can actually serve and we can actually help educate the market and remove some of this confusion. Because in my mind, a lot of the stigma comes from lack of understanding, or, you know, being afraid of what are those terms actually, and oh, you had to sign up for really bad loan terms, then you're probably not performing that well. Actually, the terms offered by people around this table are way, way, way better than you would have received 5 years ago if you would have gone to a working capital finance lender. And so I think it again connects to the difference across the US and EU, where we are seeing big differences in how well versed entrepreneurs are in using these types of financing solutions. And it comes from the maturity of the, in our case, the digital ecosystem. You know, in the US, that's a very mature ecosystem that's been around for long. And there's interesting data showing that second-time founders that are running their companies for the second time are much more inclined to use non-dilutive financing and online working capital solutions, because they've been through this journey before. They read up, they realized that actually using these types of financing solutions can have a big impact on my personal wealth even. And so because of that, I think a lot of it has to do with market education. And I think what some of you know, us and the other players around the table are coming with is transparency as well as swift and clear customer experience.
Yeah, really. I definitely agree with the point about business following consumer when it comes to lending. And I think we've seen a lot of that. So moving on to my next point, which we'll also time, we've got a question here, so I'll tie that in, is actually around how we see the sort of products and features being offered by what we'll call modern day lenders rather than alternative lenders. How those products and features and customer journeys are really driving momentum in this space, really driving. They are probably the innovations that are driving the most momentum in the space. What you think those key products and features are. And also there's an interesting point here that ties slightly into that about sort of from Andrew Howard saying how it's interesting to hear about sort of access to real-time data and underwriting. And do we think that's allowing more forward-looking risk modeling rather than sort of retrospective risk modeling, which was always been used in the past? And to go straight in on that, because it's quite interesting purely because of the lending model that you use, it'd be good to hear again from you on that, Henrik, especially with the revenue-based lending model. I think that ties in quite well.
For sure. And I think it's, Andrew is hitting the head on the nail. I think this is exactly what we're doing, right? And I think I mentioned in the intro sort of the programmatic funding model that we built at CapChase. It's all about looking at the current snapshot and optimize the financing for a particular business and a particular use case, at any point in time. So instead of doing what you've done historically, right, where you do big drawdowns of capital on a 12-month cadence, and you keep that in your bank account, and you're obviously paying for the whole thing throughout the entire process. What you do instead is you do smaller increments. You draw down just what you need, and you invest that into the initiatives that you want to invest into. You monitor the ROI. If it performs, you keep drawing down. And I think that's the ability that's the sort of type of product and innovation that you can build once you get smart about real-time data and also smart about projections. And so I think, that's one example. And I think Andrew, formulated it well in terms of forward-looking risk modeling, rather than sort of what you've done in banks for years, right? When you look at 5-year historical P&L and sort of say, oh, sorry, you're not profitable on a yearly basis, then, let's go find someone else. So I think that's just one example, but there's multitude more. And I think we're all going after sort of our different segments and tailoring to those different use cases. But it's all about being more precise.
Great. And Piotr, that point to you on what are the new sort of products and features that are really driving momentum. From what you've seen, what are the real sort of innovations on that side of things that have, again, drawn people to you quite quickly, and that have, meant you've sort of started to capture customers quite quickly? Yeah.
Sure. I think there's a few things. One is the speed. I think, there's nothing else when the founders want. Founders don't want to spend time fundraising. Founders don't want to spend time going to the bank and discussing the debt. And I think they really, initially when we were starting the company, everyone was asking, like, will people give you access to the data? They were worrying about, hey, like, are they really ready to do this? Well, in return it turned out to be not an issue at all. And people are really willing to give you access to all the data, as long as this means they can get the decision, same day, next day. And this is what we're offering to them. You don't have to waste time preparing the reports. You don't have to waste time, presenting. Just give us the access to the data. We have access to the real granular data behind, and we're able to make the decision based on this. So the speed is one thing. Second is the nature of a product. I think revenue-based finance means that if your revenue go down, your repayment goes down. And this is especially for the e-commerce companies where, they have seasonalities, they have, stockouts, but, they also have other issues. This is great because, they don't have the ability to forecast their revenue very well, and they're always worried, will we be able to afford this loan? So this revenue-based finance element of this product they were really drawn to this. And finally, it's about the security. Typically, historically, every lender who lent to this subsegment of their customers, they required, personal guarantee or the pledge or the charge over the business. This is something we don't ask for, and the founders finally can have peace of mind, and they know they will not go after them if they're, for some reason the business will not deliver what they promised.
Interesting. And Steve, just moving on to you, same vein of questioning, what are the key products and feature fits, but it will be interesting to see again, being slightly one of the more sort of seasoned players in the market, how you've actually seen that evolve. Has it changed from, for example, amount and rate to speed, or has that gone vice versa? I mean, what are the changes in product features and sort of fit that you've seen over the years?
Yeah, absolutely. And again, I echo the points made already. I think data integration, leading towards instantaneous decisioning, is a huge innovation that will continue to look forward, as we've highlighted. Speed, I'd absolutely agree. And a lot of process automation, I think, is driving that speed. And the third one I would add to the points that my colleagues have raised, which I'm sure is probably one we'd all talk about, is I would say the access point. So embedded lending is another really, really big theme that we've seen. And I come from the SaaS world, having come into the fintech world, and I passionately believe this embedded space is going to be a massive one as we think about next year onwards. So if you're, a small business owner, I think one of the innovations is, how do I sort of get access to this at point of need finance without necessarily having to come out, go and talk to my bank, go and talk to someone separately, but from within my system of record. So that's the big one we're seeing: integration with the likes of accounting systems, your marketplaces, et cetera, et cetera. So at the point I'm raising an invoice, there is opportunities to trade that and actually get access to cash at that point.
Yeah, that's really, and actually that moves on quite well to sort of the last set question we had, which was really around embedded finance and how we see embedded finance actually continuing to help this sector innovate, why embedded finance is becoming so important in the business, this very new digital and integrated business world, as you mentioned, access points and so on. It's interesting for me because that's, as the LendTech consultant at Currency Cloud, that's probably one of the biggest things I see people doing with us is they're actually setting up infrastructure so they can allow that embedded finance offering to run very smoothly, from their own risk assessments and risk engines working very smoothly to then the complete payout and collection all working very smoothly and very automated. So that's a really interesting talking point for me and from my own background in lending as well. So if I could put that over to Henrik first, what are you seeing again between the US and the UK with embedded finance, and how important do you think that's going to be for these new age lenders to actually have the capabilities to do that, and sort of the more extensive APIs, the much better customer journeys through integrated options, and how do you see that growing over the next few years?
Right. So I think, first of all, in terms of how do I see it growing, I mean, it's definitely growing a lot, right? And I think it comes back to some of the points that I made earlier. It's all about precision, and it's all about use case driven financing, right? I think this is all about being able to serve the right product at the right time with the right profile, depending on the need. And I think all of those things will essentially be transpire through more embedded finance offerings, right? It's all about getting the right product and the right offering at the right time, such that you can serve the use case that you need to serve. And that's why we're seeing a lot of excitement around embedded finance, right? You can essentially serve the product at the point of need. The beauty of it is that a lot of the infrastructure has been built already. And so the world is now actually quite ready for this. And, if you look at the US versus Europe, I would argue that Europe is even better suited, right? In terms of having been an early adopter of open banking, having been the leader really and the defining sort of body of how open banking should work, and having been early on setting it up. So if anything, I would argue that Europe is actually quite ahead on this space. Obviously, there's a booming tech sort of scene on the other side of the Atlantic that we're obviously serving. But I would argue in terms of open banking and the capabilities to allow for embedded finance, Europe and the UK is in a really good spot. And I think we will see a lot of interesting things from probably all around us here around the table, as well as other players in the market to go after this opportunity.
Really interesting. And Piotr, same to you there, sort of on the embedded finance piece. I'm sure something you guys think about quite well, being sort of completely digital led.
Yes.
Again, how do you see that sort of thing progressing? And again, are there sort of key things that need to happen to allow that to progress even faster, or are there things that have happened recently that you think are really now driving people to want this embedded option?
Yeah, I think embedded finance is something we're of course looking very closely at, and figuring out what really is the play here. On the other hand, we are quite torn, on our main product, because our vision is, as I said, to become this neobank for the digital entrepreneurs, and we want to be able to offer the full product offering to our customers. Frankly, our view is that revenue-based finance on its own will become commoditized in 5 years' time. So if it's commoditized, we're really disadvantaged when you play in this revenue-based finance game. Let's say if you have 5 players embedded within some kind of platform provider, and it's all about giving the lowest cost of capital, is it even the the place you want to play? So of course, but it allows you for a cheap and efficient distribution and get the scale. So we are thinking a lot about this space. We're also looking a lot at what are the areas which are very data rich, where we could, which we could enter. We started with the e-commerce companies because there's so much wealth of data there. We get access to their e-commerce data, payment processor data, advertising data, accounting, banking data, and that allowed us to build a product which is so loved by the customers. I think many new areas are being.
Oh, I think we've lost Piotr there.
Digitized now.
Indeed.
Hey, sorry, I'm back. Yeah, I don't know where you lost me.
Yeah, just onto coming about how many areas are becoming digitized and
yeah, exactly. And I think there is a lot of new exciting areas which are becoming more digital, right? Like think about the restaurants area where there are digital POSs and this space is getting digitized, or many other verticals overall. So we are of course looking at this space and thinking where to expand. At the same time, we have so much work to do in our core vertical. So I think we're watching this space, and we'll definitely expand the product range soon. But there will be more to announce in next year.
And that actually leads on quite well to you, Steve, because it's really interesting to hear. Obviously, the sort of different models and different sort of operating models that lenders are moving towards. For example, Uncapped moving more towards the neo-banking side. So as he quite rightly mentions, the embedded finance side probably isn't the main sort of driver for them. But I know with market finance, obviously slightly larger operation, longer running, but you guys are one of the first probably movers to move into sort of initially more manual partnerships with the likes of Barclays and things like that, but are then driven forward into this now, looking at much more of the embedded options and so on. And I know that's something you guys are looking at. So it's interesting from your perspective as more of a looking at a pure core lender model rather than moving into the neo-banking model, how that differs with you guys and how you see embedded finance affecting you and your future growth.
Yes, absolutely. And it's interesting as we start widening that, what I call partner ecosystem as well, and there'll be some partners where, we'll play a very, very specific role, and we'll complement a set of products that partner's got if it sits in a financial service industry. And that's one model. And they'll be very, very clear kind of, at the point of a requirement from a customer, probably what the right product is. But as we start embedding into, other ecosystems, take the tech ecosystem, take the accountancy products, Xero, Intuit, Sage, et cetera, at the point of need, it won't be quite so diagnosed at that point by our partner or the customer exactly what the right product is. And so that's where, what we're looking at is looking at that target addressable market of the SMEs that we focus on, thinking about the different types of businesses, the different shapes of businesses, the different type of working capital solutions that may work, the different type of longer term solutions, and trying to build the products, to make sure that we can service those different niches and those different requirements through a number of channels, but increasingly that embedded channel as well. And what I would say, I think the thing that I find interesting and exciting about the embedded channel is when we start integrating with a lot of the tech organizations, they've already built out a lot of their ecosystem in other categories. And so we're coming into environments where there's a customer experience expectation by our partners and by their customers. And I think that's actually helping accelerate a number of the other innovations that we talked about earlier: instant decisioning, very fast processes, transparency, et cetera, because if I'm an entrepreneur and I'm in my accountancy system, but I'm already using that to access a number of different partner solutions, I've got an expectation of what that service will look like. And I think that's very positive for our industry, because I think that will pull us forward into delivering an excellent service very, very rapidly as well.
Yeah, I think that's really interesting. Again, just drawing back to my experience at iWalker and within lending, and actually since joining Currency Cloud and infrastructure builds that I'm seeing here is a lot of that. It's how do we utilize or take control more of the sort of payment side of the journey, the FX side of the journey, actually utilize that data to provide better decisioning on our side and faster decisioning, and actually open up new geographies by pulling in the transactional data from those geographies. And I think that's really interesting in the embedded space. Is not just the customer acquisition side, it's that growth of data sets, which really is what's driven most of the innovation in sort of alternative or new age lending as is. I've got a few questions here that will be quite interesting and lead on quite well to things we've spoken about. One from Roberto Estaba on YouTube, which is quite interesting, just saying, how do we really see traditional lenders reacting? Do we think they will react quickly? I know we've seen a few acquisitions and a few attempts at doing various things. Some have gone well, some have gone not so well. But how do we see that changing as the future progresses? I think initially a lot of thoughts in the market were around it's going to be a waiting game and then an acquisition game. But do you think that's changed? Do you see them actually now perhaps going full hog and trying to build out sort of alternative solutions themselves, or how do you see that progressing? Sorry, let's go with Henrik on that first.
I nearly got there. Yeah. So honestly, we haven't seen much. I think we've seen some instances of incumbents moving in through partnerships, right? Like Market Finance, right, with some of their bank partners. But however, to a large extent, they struggle, right? They struggle to work in the way that we do. They struggle to work with the pace that we do, and in particular, they struggle with the technology development at the pace that's sort of needed to catch up. And so I think I think that we will continue to see that hold, and that there will continue to be acquisitions, if anything, right? But I think from what we've seen in our segment, there's not a lot. And I think incumbents doesn't only mean the 50-year-old banks. Incumbents, we even consider incumbents that are very digital focused banks that are not much more than 10 years old. So and even they struggle to keep up the pace, right? In terms of innovation on the product, in terms of innovation on the customer experience. And so I think we will continue to see that gap, and that whatever drives it is either through deep partnerships, but we all know sitting on the operator side what that means in terms of time and effort. So I think that the main solution for them will be acquisitions.
Yeah, that makes absolute sense. And Piotr, same to you. Do you see the same thing in terms of how traditional institutions are going to react, or do you think there'll be a different route they take in some instances? Oh, no, I think we've Piotr's frozen again. So Steve, if I go to you on that question.
Yeah, absolutely. So I think the most common theme I'm seeing is I personally think sort of a lot of the banks have evolved a little bit in their thinking. I mean, they've got so much to do, so many segments to service, so many products, such a large infrastructure, that I think they've evolved. Almost all the conversations I'm having with them, they've evolved and said they can't be all things to all segments, and they're acknowledging that. And so what I'm seeing more and more about is banks kind of working out, what's their focus and what's the right set of priorities to get their returns, and what gaps does that leave, and they're starting to get, I think, more conscious about what gaps that leaves. On the flip side, they also absolutely want to retain the relationship and the ownership of that customer relationship. So again, I think those two things are coming together. And so a number of the conversations are saying, okay, we need that relationship. We're going to be providing certain products. We know we've got gaps. Can we have conversations about how you can fill those gaps and become part of ultimately the value proposition for us as a bank? Some of those start with a less integrated approach, but more and more, as they start evolving their digital journeys as well, I think it's getting more and more digital. Yeah. So that's the big theme I'm seeing right across the board at the moment.
Yeah, absolutely. And just bringing it back to the risk modeling and so on, and some of that side of things, again from YouTube. Sort of, we've got here, how much training do the models need based on historical data, and how much customization is needed per geography? Quite interesting. And I think one of the things that's we've already mentioned is part of the point of new age lenders being so integrated is actually to pull that new age or sort of new data or those fresh data sets in. But it is interesting to see what that split is at the moment. Is it still more reliant on historical data, or is it now moving towards much more of a mix of historical and actually sort of AI and machine learning, leading more towards actually we're able to look at some historical data and sort of map out much more into the future, and that's where we focus on. And it may be, again, interesting to see the differences there between the different operating models. So Steve, if I come to you on that first, and then go to Henrik, and then I'll repeat the question for Piotr.
I've heard the question. Fortunately, I've heard the question.
Great. So yeah, Steve, if I come to you first on that, about sort of historical risk versus sort of looking forward, do you think that's still on your side of things more reliant on historical, or is there a transitioning happening there?
Yeah, I think for us it's a combination, and so I think the historical, data, even though there's evolutions in that through the, providers that we all know, I think that's relatively stable. But and we certainly use that. So the innovation and I think the iterations are taking that and then overlaying on that some of the newer data, the forward-looking data, the data we've talked about here, open banking, APIs into finance systems, et cetera, and having a technology and a data science team that can rapidly innovate on that. And for us, it's just a process of sort of continually tuning that, and I'm sure that will continue for the foreseeable future as well.
Yeah, absolutely. And again, Henrik, if I move to you with that question, just interesting because of the slightly different product set and the slightly even different target customer base with the completely sort of much more digital based customers generally. Do you see the same thing, or with your model, is it actually more important now that you can really accurately analyze sort of forward looking predictions and so on?
Yeah, so I think actually looking across geos that we're working in terms of performance of sort of analyzing historical data, it's not a huge difference, right? I think it comes much more down to what Steve alluded to, which is, are we able to tap into new data sources? Are we able to do that in a swift way, in a way that doesn't impact customer experience, and that has a very sort of solid prediction ability in terms of how this company can and will perform in the short term and long term. And I think what is interesting, however, in terms of geography is, and where I think we are a little bit behind the US, is the fact that Europe is a very fragmented number of companies, right? Countries. We are seeing, when you're thinking about the types of data sources that we are tapping into, doing that across all of Europe, that's quite a feat technologically. And because we are using, across different regions, are using different platforms, different data sets, more or less mature. And I think that is rather sort of in terms of geography expansion and sort of geographical implications, I think it's more about data access at all and whether we are able to tap into them in a friction-free way, actually more than it is about how much data you have. Because with the current data models, you quite quickly build, at least if you're targeted towards some sort of segment, you relatively quickly build a base that's enough.
Yeah, and again, just drawing my own experience, I think that's one thing that's often overlooked, is that actually all lenders rely on sort of reliable historical data. And that isn't always the case in a lot of new markets. You're sometimes for example, in the UK, we've got 3 quite detailed bureaus there. You can pull a lot of information. It's very reliable. There are other countries where there's maybe sometimes not even a sort of reliable bureau, or sometimes even it's just one, and it's still a bit fragmented. All the data's not there. And I think that's where, innovation in those markets is going to happen first. It's probably going to be on making that data reliable and available. And that's when you'll afterwards see the lending, or sort of more of the lending crowd, move into those areas, which is quite interesting. Piotr, just same with you on that side. And again, just interesting being sort of, again, all in slightly different markets, even though there is some crossover and sort of coming into play at different times. How do you see that on the sort of risk modeling side of things? Do you think historical data still takes precedence, or do you think there's a lot more forward-looking data being used now? And do you think that's actually going to be more of a driver, for example, for new products and so on?
Oh, I think, it's all about forward-looking data. I think, yes, we learn from the history and we leverage it in the data, and, we understand the historical performance of a business. But when we do the risk assessment, it's in a very forward-looking basis. The simple reason is our clients are extremely fast-growing. The same company, last year is a very different company today. Like very often, quarter on quarter, they are at a different scale, different pace. If a company is 3, 4, or 5 times bigger, you can't apply the past to these companies. And I think this is the biggest difference between what players like us are doing versus traditional lenders. So yeah, we are very forward-looking, and we have to factor in things like seasonality and trends and like general market sentiment, and things like iOS changes and ad performance. Like there's a lot of issues we have to factor in our underwriting.
Yeah, and I think that leads on well. If we come straight back to you, Piotr, on Andrew Howard's follow-up question on LinkedIn regarding sort of the micro SME space, and it's probably an area where finance has a definite market, which I would agree with. But again, regardless whether it's embedded finance or actually just getting lending as a whole for micro SMEs, which is always been historically difficult and is slowly getting better thanks to sort of more of the modern players. But for you, Piotr, do you see that actually as more of that micro SME data becomes available, which was one of the big problems, right? That micro SMEs don't have a lot of historical data. Sometimes it's very fragmented depending on how their growth patterns have looked and what they've actually put through, they haven't, and so on. Do you think as more of that data becomes available, for example, through accountancy platforms or even with yourself, if they're using you more of a neobank, is that going to progress the micro SME space in terms of lending and availability?
Of course, I think, this is players like us are, finally allowing these companies to finally get the credit, because, we are able to understand the performance of Amazon over the first 3 months. And based on this, we can take a first risk, and give them, hey, we see what you're doing well, you have a good ROAS, good margins. Hey, here is some money. Maybe not as much as we would give proportionately to the more mature business, but hey, here's some money to play with. Keep growing the business, keep buying more inventory, spend more on the ads because you have a good ROAS. And I think of course we hope to the next to lend to next 20 million of small entrepreneurs, because these micro SMEs, our view is these micro SMEs will not be offline businesses anymore. It has never been easier to start a company selling things on Amazon or Shopify. And, we want to be the first platform they come to for capital, for finance, for financial products when the founders are starting these businesses.
It makes absolute sense. And Steve, coming on to you, again, coming at it from a slightly different angle as with sort of core lending at your base. Do you see sort of, I know you've already got products that actually service micro SMEs and you have for quite a while now, but do you see the embedded finance option actually being something that's going to grow quite significantly for micro SMEs? Do you think that's going to be one of the key customer bases that embedded lending allows for?
Yeah, I do. And a generic comment in terms of kind of the market need and opportunity. There's I think as Piotr highlighted, there's without a shadow of doubt a big need to help fuel those micro SMEs, those new entrepreneurs, and therefore a big opportunity to do it. It's got to be even simpler, in my view. For those smaller businesses, they've got even less resources, even less time. Often it's just one person, doing it. So when you think about simplicity, and I think you think about embedded finance, I think they come together quite a lot. So I do think that will trigger it and be a driver for it as well.
Yeah, I absolutely agree. And I think with micro SMEs, as you say, it's got to be simpler. It's got to be almost a mirror image of consumer lending.
Consumer, yeah.
For it to be sort of viable for them. Henrik, just moving on to you with that side. And again, as we've got you here, it'd be interesting to hear how you see that side of things on the US versus Europe and the UK. Do sort of the micro entities have it much harder or slightly easier in the US compared to the UK, or what have you seen on that side of things?
Yeah, I think this is sort of it's a historical truth, really, that there has been challenges in serving the micro SMB segment, not only because of lack of data, but also because of profitability challenges, right? With more data and more automation that we can get through APIs, we are able to serve them much more efficiently, not only in terms of what we can offer in terms of a loan, but also how we can actually serve them throughout the customer journey. To make sure that the unit economics makes sense, right? So I think that's, I think that holds across both the US as well as the UK. I think one interesting sort of thing that we realized, though, when we look at our customer base is, the way that data-driven lending in the way that we are doing it is really leveling the playing field, not only about sizes of companies, but removing any type of bias. It's now all about data and the performance of your business, not who you know or where your parents worked or what you've done in a previous career, right? It's all about how your business is performing. And I think that's a very interesting theme that we're seeing with our customer base in the US, where we are actually serving historically very underserved segments. And I think that's something that's very interesting that's related to this as well. It's not only about size, but it's about other historical blockers that have locked out certain segments from the market, and that sort of playing field is being leveled. So I think that's a very interesting dimension that we're seeing a lot of, actually.
Really interesting. I think that brings us to the end of our questions and our talk today. By all means, if any of you have sort of got anything you'd like to follow up with, we'll probably do some sort of follow-up questions and a bit of content that we can release. So if we get questions in from LinkedIn following this or anywhere else, we will try and come back and answer those sort of over LinkedIn in articles or so on, and probably reach out to each of the speakers independently to get their views to make sure we cover them. But I think that's it for today. But thanks very much for joining, guys. It's been a really interesting talk, and it's great to have sort of such a good base of lenders. I think they're all doing such innovative things all in their own right. I think it's good proof that although there is a lot of crossover in modern day lenders, there is so much happening in different levels that there's still so much space for innovation and sort of lenders to grow and grow and grow. It's going to be a really interesting space to watch.
Indeed.
Thank you very much.
Thanks so much for having us.
Thank you.
Bye.